Thinking Byzantine here. Today I'm going to be showing off my version of the all-weather portfolio. Now before we begin, I'd like to say that I'm not a financial advisor and this is all my own opinion. Your investments are your own responsibility. The information that I'll be using was from January 18th or before. Now what is the all-weather portfolio? The all-weather portfolio was created by Dalio in an attempt to create a portfolio that works well in a bullish or bearish market and or a inflationary or deflationary environment. And if you want to see my video on Dalio's all-weather portfolio, go to the description, the link is there. Now here are some flaws that I perceived with the original. It's low growth compared to riskier investments, which is an opportunity cost right there. Is susceptible to a rapid increase in interest due to the fact that most of this portfolio of the original all-weather portfolio is in bonds. And there's no international stocks, though some US stocks have large operations outside of the United States, like Apple and Microsoft. Now, to address low growth, I'm going to try adding VIXes, or the total international stock market, and we're adding Bitcoin, which is a bit speculative, and you're free to choose any coin or any crypto you like, but we're just using Bitcoin, because it's the most well known and it's the biggest cryptocurrency by market cap. And we're removing DBC since it's been declining since inception, plus it has a 1K tax, which is, if you are a bit lazy, don't want to do that tax part of the tax form, yeah, maybe DBC is not for you. And future contracts do not necessarily track spot. And here's the performance of VIXes compared to SPY from 2000 to 2011. Seeing this could be used to justify adding VIXes, as you can tell here, VIXes outperformed SPY during this decade. Now, to address rapid rises in interest, I'm adding SHY and removing IEF. Now, SHY is the short-term bonds, and IEF are the intermediate-term bonds. So, bonds decrease in price when interest rates increase. And when you have, let's say, an intermediate bond that's issued at 1% interest, then when, let's say, interest rates go up to 3%, the price of your bond would go down, so you're losing value right there. While if you had SHY and you're like you bought the bond when interest was at 1%, well, the bond is shorter term, so you could pay back the money quicker, and you can buy another short-term bond that's been reissued at that higher interest rate. While if you're stuck with intermediate term bonds, you'll have to be holding them for 7 to 10 years before they're reissued at a higher interest rate, or to get your money back anyway. And here are some other changes. We have slightly lowered the long-term bonds, TLT. We added BNDX to expose myself to international yield curves. And we reduced the percentage of gold and added some silver. Now here's my version's allocation. We have 35% into long-term US bonds, 30% into the US stocks, 10% into total international market, 10% into short-term bonds, 5% into silver. You can use physical as well for gold and silver. And I've also put 5% into gold as well, 4% into BNDX, which is, like I said, the total international bonds, and then 1% into Bitcoin. Now, here are some of my risks that I've found versus Dalio's all-weather portfolio. I guess it has a higher market correlation. Short-term interest bonds, like I explained earlier, well, they do have a drawback. And in that case, when interest rates are lowering, well, the short-term interest bonds, the coupon rate, you won't be able to, let's say, these short-term bonds were issued at 5% interest. well, you're not going to be able to keep that coupon rate of, let's say, 2% as those, since you're going to get paid back in, let's say, a year. And then if you want to issue another short-term bond, you're only going to get, let's say, half a percentage point. While with an intermediate bond or a long-term bond, you can keep that 2% a lot longer. Now, Bitcoin is risky and a bit more speculative, so that's why we tried locking only 1% of my portfolio to Bitcoin. And as you can tell from Bitcoin swings, it can drop fast and go up fast. So, like I said, it is more speculative, and I just think it's something you could have as a calculated risk. And overall, this portfolio is a lot more complicated to manage than Ray Dalio's all-weather portfolio, mainly because there's so many more different allocations to this portfolio than Ray Dalio's portfolio. And here's my performance versus S&P 500 and Ray Dalio's all-weather portfolio. So when comparing my all-weather portfolio to Ray Dalio's, you can see that mine has outperformed his a bit within this 6-year time span, but it did have a worse year than Ray Dalio's all-weather portfolio, and a worse year than the standard S&P 500 at negative 4.6% to negative 3.25% for Ray Dalio and negative 4.52% for the S&P 500. But the best year for my portfolio is a lot more than Ray Dalio's by around 9%, though the S&P 500 still beats this portfolio by around 4%. And its max drawdown is still going to be a bit higher. Actually, it's lower than Ray Dalio's portfolio at negative 6.56%, and it's a lot lower than S&P 500, which is close to negative 20%. So as you can tell, this portfolio does not perform as well as the S&P 500 in terms of total gains, but its max drawdown is a lot less than S&P 500. So if you want something like a smoother ride, if you say, then maybe this portfolio is for you. But you can also create your own all-weather portfolio using the principles that Ray Dalio used to create his. And if you want to watch that video, like I said, it's in the link, it's in the description. And please like and subscribe for more content, and tell me, what do you think of my portfolio that I created, and would you choose mine portfolio, the S&P 500, or Ray Dalio's portfolio? This is Thinking Byzantine, and have a good day.